Hello everyone and welcome to the course. My name is Trades, and in this course I'm going to take you from having zero knowledge of the financial markets to understanding how professional traders analyze and trade, with a special focus on NASDAQ or US 100. If you have ever wondered what Forex is, what stock markets are, what interests are, or why people make career trading financial markets, then you are in the right place. This course is designed for complete beginners. We will build your knowledge step by step using simple explanation and real market examples. By the end of the course, you will understand not only how the markets work, but also how to analyze and trade the NAS 100 or the NASDAQ with confidence. So without wasting any time, let's begin with the most important questions. What are financial markets? Okay. So in this comprehensive guide to the market assets, we shall start by understanding what are financial markets. So a financial market is a broad marketplace or platform where buyers and sellers trade financial assets, including currencies, stocks, bonds, commodities, and derivatives. Financial markets serve as a backbone of the modern global economy by facilitating the allocation of capital, enabling businesses to raise funds, and allowing investors and market participants to manage financial risks or speculate on the future price movements. So, literally, the financial market, this is what you hear people saying, uh, the world market. In the other side, you call it the world market. Because if you ask someone, okay, you're talking about the world, where is it found? Is the world market found? Okay. So, but now the price that is determined on the physical commodity or the physical asset is determined in the financial asset market. All right. So in this market or the financial market, they don't only trade what you people know as Forex, no, or the pairs. They trade many things. Okay. We have currencies, which is the Forex that you know. We have the stocks. Under stocks, we have Facebook, of which we shall look at them in detail. We have bonds, we have commodities, okay, we have derivatives, and many more as we shall look at in the following slides. Okay, so major classes and types of financial markets. So financial markets are divided in two distinct asset classes, each with a unique characteristics, operating hours, and market dynamics. Okay, so the financial market is divided. It's not like it's one which most people know as Forex. No. Okay. And each has its own characteristics. The first is not the same as the index. The index is not the same as the stock. And the stock is not the same as the bond. The bond is not the same as commodity. Okay. And they all have their own operating hours. They don't operate on the same time. Each has its own operating time. You get my point? Okay. So let's look at the asset classes and the key features with examples. Number one, have the foreign exchange, which you people know as the Forex market. So the largest, most liquid market in the world, okay? So this is the largest and has the highest volume of money within the world, okay? So with over 7.5 trillion daily volume, okay? So in this market, you find that every day, the money that is into play within the market is 7.5 plus trillion US dollars. Okay, so that's the big chunk of a cake which you also want to bite on and grab something on it. Okay, so it operates 24/5, not 24/7, 24/5. By 24/7 it means like it operates from Monday to Friday. Okay, within the 24 hours according to the sessions, the London, the New York, and the Asian. All right. So the examples of this forex market, we have the Euro USD, now the pairs that you know, the GBP USD, the USD JPY, the Audi USD, the USD CAD, the Audi CAD, and so many. Okay, so this is mainly for the forex market. Okay, the pairs. So and then we have what we call the stock or the equity market. The equity market, all right, is market for buying and selling fraction ownership or shares in publicly listed companies and operates on localized exchanges with fixing trading hours. Okay, so with the stock market or the equity market, this is whereby now you buy a share in a given company. For example, like Apple, as you can see, the examples are Apple, Microsoft, Tesla, Nvidia, we have Meta, we have Alphabet, so and many more, right? So you buy a share in that listed company, okay, which they call a stock. So you take part, you own part of the biggest company. And then another class asset we have is the indices or the index futures. So basket of the top performing stocks representing a specific sector, exchange or economy, high liquidity and clear directional trend. And examples of the NASDAQ or the US 100, which I do trade. We have the SP 500, we have the Dow Jones, we have the DAX or the German 40, we have the YM and so many more. Okay, so when we come from the stocks, here, right, we come next to the indices. So the indices represent the best performing stocks. Okay, so when you talk, like, for example, the NASDAQ 100, right, you find that inside there you will find the best performing 100 companies of the economy of the United States, not an other country, of the United States. Okay, and we say they have clear directional trend. If it is bullish, it's going to be bullish overall, because remember, these companies, they want to keep making money over time, not making losses. Then we have what you call the commodities, right? So these are raw materials, okay, divided in the market, which are majorly mined, some, right? For example, the crude oil, okay, others are mined and others are farmed on the farms. So we have the crude oil, we have the natural gas, we have the wheat, we have the coffee, we have the corn, we have the soya bean, we have cocoa, we have cotton. All those are commodities, right? The commodities are things that, commodities. What's a commodity? Raw materials and other things. Okay, so these also are within the financial market. So the price of, let's say, coffee will be determined on the, for example, the price of coffee in your home country, or the price of oil in your home country, or the price of wheat or cocoa in your home country will be determined by the price of that commodity in the financial market. So literally, one may want to go onto the ground to do the business, and another one may try to trade it on the financial market. And either way, it should make profits depending. Then we have what's called the precious metals. This is a subset of hard commodities, okay, used as a safe haven asset, inflation hedges, and industrial resources. So, like how the indices are part of stocks, commodities are part of, precious metals are part of commodities, whereby people seek to hide in money, okay, to protect themselves from inflation, and others use them as industrial resources because of the demand by the industry, so they know they can make money as price keep on appreciating over time. Like gold, we see gold always pushing higher, the prices are always going higher. So as other people are going to Congo in Africa to look for gold, to kill each other for gold, other people are literally making what? Making money off gold by trading it within the financial markets. Okay. So that is it about the major classes and types of financial markets. So let's look at Forex trading versus future trading. While both Forex and index future allow traders to speculate, someone may ask themselves, what is speculation? Speculation is just like trying to predict, okay? To predict something that does not yet happen, okay? Or try to create a rumor around something that has not yet happened. The thing that has not yet happened, you try to create a rumor about it, speculate it, to spread it, okay? On the market movements using leverage, okay? They differ fundamentally in structure, drivers, and underlying mechanics. So these two, the forex and the futures market, they are all in the financial market, but they differ in the structure, okay, and the market drivers are like what drives them into movement. For example, the indices, we shall look at what drives them, okay, later on, or the futures, and the indices, okay, we shall the index, we shall look at what drives them, and then the forex, okay, and then the underlying mechanics. So, futures, okay, this is the future, this is forex. So, future, we have the underlying assets, and underlying assets, and the forex, we have the currencies relative to another, e.g. the Euro USD, and here we have e.g. the NASDAQ. Okay. Then the index future, or the CDF, okay, which people trade under the forex sector. It is a basket of two publicly completed corporate equities representing an economy or an asset. Okay. So primary drivers. We have the central bank interest rate, macroeconomic indicators, the GDP, the CPI, the geopolitics. So when we see the what that there is news or the interest rates, we know these are going to impact our market. For those people who are already trading, or when you start trading, we say that when there is news, we shall look at later on the fundamental analysis. We shall find that before you press a trade, before you do anything, you're supposed to look about you are supposed to look on the economic calendar to know what's going on the calendar. Okay, are we going to have this week maybe CPI? Are we going to have NFP? Are we going to have maybe some interest rates? Okay, is Trump going to speak? So all these things affect the financial markets, both the forex and the future. So uh, now the what under the index or the future trading, we have the corporate earning release, technological innovations, economic growth, and interest rate policies. So you find that though these also sometimes affect the futures, okay, but you will find that technological innovation, economic growth, and interest rates affect the futures market more. It affects them more on the long term. Okay, let's say for example there is a decline in Tesla technology. That means that the shares in Tesla may drop, and the moment that they drop, there will be a pullback within price action, even though there's no CPI or one. Okay, so it's very important to look at that. So we look at the market structure, decentralized or over the OTC, which means over the counter, network, global cross banks. Okay, so this is trade over the counter, and you find that it's decentralized. That means no one really controls the forex market, the forex trading market. At the futures, you have that it is a centralized market. Okay, that's why NASDAQ is measured a USC asset or a USD company based, okay, because it deals with a given group of companies within the USC economy, unlike that for the EU USD or the GBP USD or the GPY. Okay, so this one is that for the indices, they are centralized. The forex is decentralized. Okay, so look at that trend behavior. So you find that under the forex, frequently trades in wide horizontal ranges, highly sensitive to microeconomic shifts. So you may find that sometimes ranges, and when there's something small news can easily affect it and maybe affect its direction or movement. However, for the futures or the index, you find that there is stronger long-term upward trend bias driven by economic expansion and corporate growth. So you may find that if you look at the chart of NASDAQ or the US 30 or the SP 500, you find that it's more of an uptrend because, like I told you, the companies want to keep on making profits and like other things. So let's look at the key advantages of trading futures or index or indices over forex. One, we have the long-term bullish structure bias. Index futures represent the top revenue generating companies in the economy. Weak companies are periodically removed and replaced with rising giants. Consequently, indices tend to grow over time. So you find that for them, they are in the bush. That means someone like I told you, they are part of the stocks. And stocks, they always push higher. So that means someone, as long as someone is looking at the long term, okay, as I'm a swing trader, if I'm looking at long term, I know it's going to buy. I know. It may pull back, yes, but I know it's going to buy. It's going to go bullish. I know. Because unless you want to tell me that Apple wants to make loss, Tesla wants to make loss, Amazon wants to make loss, Alphabet wants to make loss, then you tell me that it's going to keep on dropping. Mhm. But if it's not that, that means it will go higher. Okay. Yes, I can get some short-term swing lowers to some key areas of interest, but overall, long-term, I know it's going to go higher. Okay. So let's look at cleaner price action and the volatility. Major stocks, major stock indices like NASDAQ experience smoother momentum moves, especially during the US session open market, creating high probability intraday trading opportunities. So NASDAQ has a clear structure, unlike the Forex trading, because you know it's going to open at the New York session, during the New York session, okay, which is the 8:30 or the 9 or 9:30, depending on the season, whether it's winter or summer. So obviously, we shall look at that in detail when we are looking at mastering NASDAQ or NAS 100 later on within the course. So it is clear, and you can easily capitalize on the movements within the due course of the day. Unlike Forex, you may find that the someone is looking in Forex for 1 or 2 weeks, 1 week, someone in the index market can capitalize on them within one day in form of points. So that's it. No relative currency tug of war. So in Forex, you are always trading two economies against each other, e.g. the US economy versus the European economy. In this trading, you are trading overall corporate performance and growth. So in Forex, you are like, okay, the way I see now the European economy is stronger than the US economy. The dollar is now weak and the euro is now stronger. You are in a fight of two economies, which you don't know in the depth of them. Okay. But in the futures market, you are trading the performance of these top companies. As long as you know the companies are performing well, you are bullish. If they are performing poorly, they are bearish. Simple as that. So, insulated from single company risk, okay? Unlike individual stock trading, in index is diversified. An expected earning collapse in one single company rarely destroys the entire index trend. So, for example, let's say Tesla experiences losses and now it drops, okay, in price. It won't affect the other 100. No, the trend will still continue. That's just like a small thing within the Tesla, okay, which it will cap up and cope up with the rest. Okay, so let's look at the major index futures and leading companies. So stock indices are benchmark portfolio formed by weighting key industry leaders. Here are the most heavily traded index futures worldwide. So we have the NASDAQ, okay, or the US 100, which are the top 100 non-financial, like what? Like the Microsoft, Apple, Nvidia, Meta, Alphabet, okay? Then you have the NAS 100, okay? The NAS 100 and NASDAQ, they are relatively the same, like 99% the same thing. Okay, we have the Google, Tesla. So these and these, don't be confused. It's the same thing. It's the same thing. Okay? Though with the difference that this is the NASDAQ index, which comprises of the top 100, and then the NAS 100, now it's the name of the 100 companies. It's just still the same thing. This is a child of this. It's within the same thing. So don't be confused about that. Just like how we are having here the US 500 and the SP 500. You see? Still the same thing. Still the same thing. Like this one is the same thing. Okay? So still comprises of the what? 500 largely US publicly traded companies. Okay? The JP Morgan, the Microsoft, okay, the Apple. So even at most of the players within the US on the NAS 100 still are within the US 500. So either way, you will choose to trade this or trade this. But in most cases, you may find that they correlate. If this is bullish, you find this one is bullish. Okay. Then we have the Dow Jones. Okay. So Dow Jones an industrial average, 30 mega companies in the US blue chip companies. So this one deals with the what? The industrial average what? 30 mega blue chip what companies in the United States. And then you have the German 30, the German 40. Okay. We also have the German 30. So we have also we have the German 40, what we call the DAX 40, okay, which deals with the Germany's 40 listed best performing stocks. Okay, so our major focus depends on the first one. All right. So now what is NASDAQ? So we're saying the NASDAQ index, okay, or the ticker US 100 or NAS 100 is an equity index that tracks the 100 largest, most innovative non-financial companies listed on the NASDAQ stock market. It is heavily weighted towards technology, biotechnology, consumer service, and communication. So you find that NASDAQ is in line with technology. Mostly tech companies are the ones that form up this, and consumer service and communication. Okay, so we are saying now this is a hint. Did you know that because tech giants like Microsoft, Apple, Nvidia, Amazon, and Meta make up a massive portion of the index total market capitalization, performance in the technology sector heavily dictates the direction of US 100? Did you know that the movement of the market is majorly determined by the performance of the technology sector? So if the technology sector is going well, is doing well, then NASDAQ will do well. Okay. So why should one trade the NASDAQ? Number one, exceptional volatility and liquidity. The US 100s provide significant price expansion every single day, particularly during the New York session, 9:30 a.m. to 4 p.m. Eastern time, okay, the US time. This offers day traders abundant profit targets. So with this one, you know the time when you are going to trade. You're not supposed to be glued on the charts 24/7. Now you know which time you're supposed to be. Are you going to trade the morning session? Are you going to trade the PM session? So you know. Okay, and the volatility is good. Clear trend technicals. Okay. So US 30, US 100, they respects technical analysis concepts such as market structure, support and resistance, order blocks, and key moving averages exceptional well. So this one, most strategies tend to work with the NASDAQ or the US 100. Yeah, you had me right. Okay, they tend to work with it, tend to respect them, and it's clear. Okay, high sensitive to marketing news. So we're saying economic announcements like inflation reports, PI employment figures, Federal Reserve interest rates, FOMC, and big tech earnings create explosive. So if it is in line with order flow, and then when there is positive news on the interest rate, price may shoot higher out of blue, and because like 200 pips. 200 points in just a microsecond. Yeah, that's how it is. And silent volatile. That's one thing you should know. Unlike currencies, which are very slow. So let's try to have a dive into this and then call it the first lesson. So introduction to the language of trading, which is the candlesticks. Okay? So we have the Japanese candlesticks are primarily someone why they use the candlesticks and what are candlesticks. Okay, so in the Japanese candlestick are the primary visual tool used by traders to analyze price action. Each candlestick tells a story of the battle between buyers and sellers. Okay, so buyers we call them the bulls, or when it is we call it the bullish move, and then sellers call them the bears or the bearish move or the downward trend, and the buyers can call them also the upward trend. So let's look at this anatomy of a candlestick. So the candlestick, okay, has what we call the open and the close and the body, and then you have the wick, right? So this is what we call the body. The real body is this one. The white portion represents the the range between the opening price and the closing price. The opening and closing is what in between here is what called the body of a candle stick body. It opened here, okay, came down, again pushed higher and closed up here. If it is green, it is a bullish body. If it is red, it is a bearish body. Okay. This is what we call the wick or the shadow. Others call it the shadow, others call it the wick. So the wick shows that price came here. It shows the trace that price came here, but it did not stay, it left. Okay. It also shows that it came here, this one here, the wick, where you don't see the body. It's called the wick, that cutting that is like one. Like a stick, this one is the wick. So it shows that price came here, but again dropped back and closed. Did not close up here. So that's why you call it the wick. The chart shows that the price moved into that direction. So you can go and make homework about this more on maybe you can watch the candlestick Bible, but this is the best you can get about this. Okay, so let's look at the essential candlestick patterns and their interpretation. So when you see a long tail or a long wick or shadow with a smaller body on the top, okay, it means that price opened here, came down, again refused to close down, pushed it higher, and then closed up here. So this is called the bullish pin bar, and other traders call it the hammer. It shows that price is rejecting, okay, and it's going to push higher. Futures a long wick and a small real body at the top. Signal sellers pushed price down, but buyers stepped in aggressively, rejecting lower prices, predicting an potential uptrend reversal. This one shows bullish market is going into play anytime soon. It's possibly to be a bullish market. Very important to master this one. You'll see it more often on key levels. And on NASDAQ, you'll see it a lot. This is the opposite of this. This one shows that futures a long upper wick, a long upper body with a small low, a long upper wick and a small lower body, featuring that buyers were aggressive, but sellers came in and kicked them out, pushed the price lower, showing that price they want it to shoot lower. This is called the bearish pin bar or the shooting star. Then you have what we call the bullish engulfing, which shows a strong bullish action. You have a small bearish body and a big bullish body. Whereby you see that this small bearish is covered by the bullish one. Okay, so this one shows that the momentum of buyers is more than the momentum of sellers. It's a strong signal, and it's the opposite of this. This is the opposite of this. So you find out that this shows the price is going up higher, and when the bullish body, which is this one, is smaller than the bearish body, signals that the sellers are trying to control the market, and the market is most likely to be bearish. So this often appearing at the top of the trend or at a key level. Then the last one we have called the doji. The doji means indecision, characterized by virtually identical open and close. You see, it's like a cross. Sometimes it can make a small body, creating a cross-like appearance signals absolute indecision. That means the buyers and the sellers, they have the same strength within the market. So no one is controlling the market. Okay. So for more about candles, I would recommend someone to read the Candlestick Bible, yeah, and understand more about candles. But still, the knowledge I've given you is enough. If you can try to remember them, those are the most essential candlesticks. The rest of the candles, you don't need to know them. Those are the essential ones. The pin bar, the bullish engulfers, and the indecision. Those are the ones I look at key levels and within the market. Okay. So thank you guys for watching. Let's catch up again in the next lesson, lesson 2. I love you so much. Subscribe, like, and comment for next educational content like this. I told you I'm going to post here a full course. a full complete course that people are paying for thousands and thousands of dollars. I'm going to post it here, and we have just gotten started. Okay, so comment, like, share, subscribe. Until we catch up again, see you. Wish you the best. Bye bye. Much love.